All right, so today we're looking at candlestick pattern. Trade smarter with candlestick pattern. Now, there are principles in trading that can help you get results, high quality results with good win rates, and candlestick pattern is one of them. Now, candlesticks were designed by Japanese rice merchants in the 18th century, and they've been adopted into the financial market to help identify price movement. You see, I always say that as a trader, what we deal with in this business is the word price. We're not dealing with any physical asset. What we're dealing with is the price of this asset in the financial market. For example, trading Forex, we're only dealing with the price, the current market price of the exchange rate of the currency pairs we're trading together. If you're trading gold, for instance, we're not trading physical gold. What we're trading is the current market price of gold in the international market. Same thing, crude oil and every other asset that is tradable. And how do we represent this price movement on the chart? It's through what is called the candlestick. The candlestick is what we use to represent this price movement. So we have what is called the candlestick chart, on our MetaTrader, which is what we use in trading. We'll check it in the course of this training. Now, this candlestick is made up of three body parts and three price levels. Now, in terms of body part, you can see the candle. Just remember our Nigerian candle. You have the solid part. That is what we call the real body in trading. If we're talking about the candlestick of Forex trading, see that solid part of our candle as that wax part is what we call the real body. Then we have the thread, which we call the shadows, the upper shadow and the lower shadow. So the candlestick in terms of body parts is made up of the real body, the upper shadow, and the lower shadow. Now, in terms of price level, there are four price levels in every candlestick we see. There is the open price, the low price, the high price, and the close. And this happens on every candlestick we see in the market. Let's go to a clearer picture. Now, this is a candlestick you can see. Now, the bullish candlestick is often represented with a green color, while the bearish candlestick is represented with a red color. Now, it's at your discretion on your own device, the color you want to use. But these are the two generally accepted or generally used colors. Green to represent a bullish candlestick and red to represent a bearish candlestick. Now, in the bullish candlestick, we have the four price level, like I mentioned, the open price, the low price, the high price, and the close. Now, for a bullish candlestick, the open price is always below the high price. Now, what is the open price? The open price, if you look at maybe the daily time frame, for instance, is the price at which the candlestick is opening for the day. Day starts on the platform by 10 p.m. in the night. So it means that is the price the candlestick is opening for the new day. Now, many times in the course of the night before the London session opens, we may have a retracement of price. Retracement simply is a temporary movement of price against the established trend. So even though the trend here is a bullish one, it's possible to experience a retracement, a slight downward movement in the middle of the night till the beginning of the London session. So when price retraces like this, it gets to a lowest price level, which forms the low. Then as the London session begins, price begins to go back in the bullish direction and it goes as high as the high price level in the course of the day. That's why when you check the price on any chart, if it's a bullish candlestick, you see that the open price, initial price is low, while as it goes bullish, price it begins to increase in terms of price value. So it continues increasing till, when the volatility begins to drop, maybe around 4, 5 p.m. in the day. And at that point, we begin to see some retracement and the market now close at 10 p.m. So the open price is the price at the beginning of the day. The low price is a retracement in the course of the Japanese session, the Asian session in the course of the night. Then the London session takes over from 7 a.m. for a bullish candle, and you see a wild movement to the upside, then a slight retracement to close the day. So for a bullish candlestick, the open price is always below the high and the close. And the opposite is what happens in a bearish candlestick. For a bearish candlestick, the open price is always above the low and the close. Now, for a bearish candlestick, price is dropping lower price is dropping lower, and as such, you have the open price. In the course of the night, you can have price to trade to the upside. Then when the London session starts, you see price dropping lower because it's a bearish candlestick. Now it drops low to the lowest price level and closes by retracement towards 10 p.m. in the night. So this is what happens on every candlestick, depending on the time frame. I only use the daily candlestick to explain how this concept works. And that's why, generally, globally, exchange rate is never the same, all through the day. There will always be changes. Either you see price going up or, or coming down, or things like that. That is how the market, really moves. Please, if you have your video feed on, I want to encourage you to put it off so that it doesn't drag our bandwidth. All right, now the next thing I want to show us is on candles is the size of candlesticks. Now, if you've traded for a while, you realize that some candlesticks are actually very big and some can be small. So the question is, what is responsible for this? Why are some candles big and why are some other ones small? Now, anytime you see a big candle, either a bullish or a bearish candle, really big, what it means is that there's a lot of volatility in the market. There's a lot of pressure, a lot of demand and supply is going on simultaneously. And that's what led to the size of that candle being big at that point in time. Now, when you see a candlestick that is small, sometimes it could mean the market is in a range or a consolidation, but generally it means volatility is low on that kind of candle. It means the market activity is very, very minimal at that particular point in time. Now, all this I'm saying is just to lay a foundation for us to understand candlestick that will go to what we really need, and that is the patterns. We go to the patterns that candlestick generate, which can help us to identify opportunities in the market, because the goal is to teach you what you need to generate trading signals which can help you make money in the market. Now, it's been observed that there are some patterns, that are generated by candlesticks, which can point us either to a bullish or a bearish direction in the market. And the first pattern we're going to look at is called the hammer candlestick pattern. And you can see that right on the screen, the hammer candlestick pattern. Now, usually the hammer candlestick pattern is always formed at the lower part of a downtrend. What we mean is that price is trending down, and at a point, we'll see a candlestick with a small body and a long lower shadow. So a hammer candlestick pattern is a candlestick with a small body and a long lower shadow. So let's treat the right up here. You say that this candlestick pattern is formed with a short body and a long lower wick. Wick is the same thing as shadow, and is usually found at the bottom of a downtrend. A hammer shows that although there were selling pressures during the session, but a strong buying pressure, see this one, a strong buying pressure draws the price back up. So what we're saying here is this: price is dropping with a massive pressure, but on getting to this region, a force pushed it to the upside. More or less, the buyers in the market were able to override the sellers, and they reverse the direction from downtrend to uptrend. So in other words, anytime you see a hammer, it means the market is reversing from downtrend to uptrend. It means it's reversing from a bearish trend to a bullish trend. And in that case, it means the hammer can generate for us a buy signal or a bullish signal. Hammer can never generate a bearish signal. It will only generate a bullish signal. So anytime you see hammer, you should know that it's time to buy. Now, there are other information you need to note about this hammer. The one here says the color of the body can vary, but generally green hammers indicate a stronger bull market compared to the red hammer. So what I'm saying is this: even though the market is in a downtrend, this candle that is called hammer, it can either be green or red. Now take note, it can either be green or red. Now, if it is green, very good. It means the buyers have already taken over the market, and it means the buying pressure is very strong. But then, even if it is a red, the market will still buy. But then the volatility may not be as much as if it was a red. I'll repeat that. If it is green, it means the bullish or the buying pressure is very, very strong. And if it is red, it will still buy, but it means the buying pressure is not so strong. a minute. All right, apologies for that little break. So, like I said, a recap. In a downtrend, you have the hammer. It can be green candle or red candle. Now, the other thing you need to note about the hammer is that after the hammer has been formed, you don't just jump into a buy trade. No, you wait for the next candle, which is called a confirmation candle. Now, this confirmation candle must be a green candle. Take note, it must be a green candle and it must be a full candle like what you're seeing on the screen. As in, it cannot be like this kind of candle with shadows. Even if it's green, it cannot be like this one that has upper and lower shadows. No, it should be a full grain candle. So that's a confirmation of entering a buy trade using the hammer candlestick pattern. Now, this is an example of a hammer. You can see the market is in an overall downtrend. We have an overall downtrend. Then we can see a hammer formed. Now, in this example, you can see it's a red hammer. And like we said, it doesn't matter whether it is green or red. It can be any. Though green means more volatility, but red, it will still buy. But like I said, most importantly, what you need is the confirmation candle. It must be a full candle and it must be green. Now you can see at the end of this candle now, that's when you can enter a buy. At the close of this candle, you enter a buy and see how price just moved on. So a hammer candlestick pattern indicates a reversal from downtrend to uptrend, and it can be used to generate a bullish signal. Now, the direct opposite of the hammer candlestick pattern is called the shooting star. So while the hammer candlestick is reversal, okay, somebody is saying no audio. Is that true? My audio is on.
No, that
Uh,
was when you
okay,
I
that was
think
when I
you
muted.
were yes, sir.
All right, thank you. So while the hammer can be used to generate a bullish signal, the shooting star is the opposite. Shooting star is always formed at the top of an uptrend, and it's a candlestick with a short body and long upper shadow. Take note of that. For the hammer, let's flip back. For the hammer is a candlestick pattern with a short body and a long lower shadow. Shooting star is a candlestick pattern. Somebody is saying, can we see what you are talking about on the screen, please? I mean, that person is not seeing me. Can others see my screen? Mr. Gaba Mukhtar, yes, you have a recorded version. Okay, everybody can see. So, Moshokbe Ibikunle, maybe you need to log in again. Probably it's a network issue. Everybody can see my screen. So, Moshokbe Ibikunle, maybe you log out and you log in again, and you should be able to see the screen. All right. So, for the shooting star is the opposite. It's a hammer. I mean, it's a pattern where we have a short body and a long upper shadow. Short body and a long upper shadow. Now, again, the color may not matter. It can be green or red, but usually red in this case indicates more volatility. And just like the hammer, you also need a confirmation candle. In this case, it must be a red full candle like this, and we'll see price will drop lower. This is an example of a shooting star. Here we see a shooting star formed. short body, long upper shadow, big confirmation candle, and you can see price dropping. Then we have the bullish engulfing candlestick pattern. Now, bullish engulfing candlestick pattern, for the word engulfing, it means it's a candlestick that superimposes itself on a previous candle. So in a downtrend, you get to see a candle, a small candle, and the next candle to it will be a way bigger candle, much bigger than the previous one. And that is what is called the engulfing candle. Now, this engulfing candle does not need any confirmation. The engulfing candle is its own confirmation. So at the close of this candle, you can trigger a buy and you see price is expected to go in the bullish direction. This is an example of the bullish engulfing, price trending downwards. Then we have the bullish engulfing, and after that, you see price reverse to the upside. So from the word bullish engulfing, it means this can generate a bullish signal. It's a reversal from downtrend to uptrend. Then we have the bearish engulfing candlestick pattern. Now, this one is formed at the top of an uptrend, and it's represented by a candle, a small bullish candle, and a bigger bearish candle. At the close of the big bearish candle, price is expected to trend downwards. So the bullish engulfing candlestick generates bullish signal. The bearish engulfing candlestick generates, the bullish engulfing generates bullish signal. The bearish engulfing generates a bearish signal. Then we have the doji. Now the doji is an indecision candlestick. It's a candlestick formed with a long upper shadow, long lower shadow, tiny, very tiny body, long upper shadow, long lower shadow, tiny body. Yeah, small upper shadow, long lower shadow, tiny body. So the distinguishing point in the doji is actually the body. The body is very tiny. It's not short, it's tiny. So you can have a long upper, long lower, or short upper, long lower, whichever one. And but the body must be a tiny one. Now, when we have a doji candlesticks are used for reversal. If you find it at the top of an uptrend, it signifies reversal from uptrend to downtrend. If you find it at the bottom of a downtrend, it indicates reversal from downtrend to uptrend. Now, I'll show a couple of other patterns. Now, we also, the next one that looks similar to the hammer is called the inverted hammer. So while the hammer has its lower shadow facing downwards, the inverted hammer is formed at the bottom of a downtrend like the hammer. It has short body and long upper shadow. The shadow is facing upwards. And this one too can generate a bullish signal. It also will need to have that confirmation candle. Okay, this is called the inverted hammer. And after the inverted hammer, we have what is called the hanging man. The hanging man is, like the opposite of the shooting, the opposite or similar to the shooting star, is formed at the top of an uptrend, small body, long lower shadow. Also needs a confirmation candle, and you see price trending downwards. Now, it should be noted that candlestick patterns are very powerful, but then they work best when you find them around resistance and support regions. For example, this is a bearish engulfing candlestick pattern, which is found around a resistance zone. Now, usually, if you understand resistance and support, around resistance areas, we can look at opportunity to sell. Around support, we can look at opportunity to buy. So in this case, where we have a bearish engulfing candlestick pattern, which is a bearish pattern on a resistance zone or resistance level, is a double confirmation that the market will go bearish. In the same vein, we could have a doji at the same point, and again, we'll still look at taking a sell. If we move back to on the slide, we will see another example. and that's the shooting star. Now, this shooting star example, shooting star is actually at a resistance level here also. So you can see at a resistance level, it adds double confirmation to the bearish breakout. So it should be advised that candlestick patterns should not be used in isolation, but rather they should be used in combination or in conjunction with a resistance and support. And that will give it a higher level of probability and a high win rate. All right, that'll be the end of this webinar this afternoon. We're going to have a continuation of this webinar on Wednesday with practicals, examples, and many other things you need to know on candlestick pattern. But then if you have any question now, you can go ahead and post it in the comment section. I will surely attend to you. So the floor is open for questions. Now,
Hello, sir.
all right, go ahead, sir.
Yes, I have small question to ask.
Okay.
Thank you for this teaching.
You're welcome.
The hammer, is it valid in all the higher time frame? And apart from that, in the daily time frame, if you look at it before a reverse back or before confirmation, before we wait for confirmation, I thought the market have gone far for us to enter to set our trade. That is one. Then two, it's like the hanging man and the hammer look the same, which I see maybe may likely confuse if someone did not actually look at it very well.
Okay. Is that all, sir?
Yes, sir.
Okay. This is hammer. Hammer is formed at the bottom of a downtrend, and it indicates reversal from downtrend to uptrend. But then it is a candlestick with small body and long lower shadow. Then did you say hanging man or inverted hammer? The second one.
Hanging man.
Hanging man. Okay. Now the hanging man is purely different. It's at the top of the uptrend.
Okay.
So it is hanging man and shooting star that look a bit similar. The difference is that for the shooting star, the shadow is up. The hanging man, the shadow is down. Are you getting it now?
Yes, I got it right now.
The same thing. Hammer and inverted hammer, they are very similar. The difference is that for the inverted hammer, the shadow is facing up, whereas for hammer, the shadow is facing down. That's just the difference between the two. But if any of it is confusing, you know what I always teach is this. If it's looking confusing, the one that is always clear anytime, any day, hammer and shooting star is very clear. This inverted and hanging man sometimes do confuse beginner traders, but for a start, just stick with hammer. It's very easy to identify the shadow facing downward in the hammer in a downtrend, and it's always very easy to identify the shadow in the hanging man facing upward. So you may just tick hammer for downtrend, shooting star, hammer for reversal from downtrend to uptrend, shooting star for reversal from uptrend to downtrend. If that's what you know for now, you are doing fine.
Okay, sir.
Now your other question.
I can use it, okay.
You can use it when?
I can use it in any time frame.
Okay, now when it comes to time frames, you need to understand something. There's what is called multiple time frame analysis. And in multiple time frame analysis, what we're doing is that we're using the higher time frame to identify the direction of the market while we use the lower time frame for entry. So let's assume you see a shooting star, for instance, on the daily time frame. Note that that shooting star is only giving you direction. You still need to go to a lower time frame like 1 hour to make proper entry. Now, if you are seeing this shooting star on 1 hour, yes, you can use it directly like that. That is if your daily time frame. Okay, let's assume, for instance, now, this is our daily, on the daily time frame, we can identify a resistance. And on 1 hour, that is where we are seeing this armor. I mean, this is a shooting star.
Okay,
We are seeing this shooting star on 1 hour. Of course, on 1 hour like this, we just wait for confirmation and enter a cell. It's perfect. But if you see it on daily, you cannot enter directly on daily. Why can't you enter on daily? Reason is because your stop loss will be very big. If you want to enter a trade on armor, your stop loss has to be above the shadow here for a sell. So while you are waiting for confirmation candle to close, you can see this gap can be a bit wide, especially on a daily time frame. So that's why if you want to use armor and candlestick, you need to understand multiple time frame analysis. If you are using it on 1 hour time frame, 15 minutes time for entry, perfect. There's no need to worry. But on daily, just use it for direction or go on a lower time frame to make your entry.
Okay, thank you, sir.
You're welcome, sir. All right. Any other question? Okay, Cheesy Nation is saying shooting star on gold currently. Okay. Looks like Cheesy is a pro trader. Any other question? Okay, it looks like we're okay. Let me just look at what this person is saying. I'll just oblige you. Normally, this class is just theory for today, but since you raised it, let's just quickly look at gold and see what you're trying to show us. Okay, so it's telling us that we have a shooting star on gold on shooting star on gold currently. What time frame? You need to be specific. What time frame are you seeing the shooting star? 15 minutes. Okay. So let's go down to 15 minutes time frame. It's not a shooting star. You see, if you're talking about shooting star, yes, I will agree this, but then you need a confirmation. You need a confirmation candle, which will be a red candle facing downwards. And that never happened. And that's why I told you, you must wait for confirmation candle. Very, 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 very important. Very important. You must wait for a confirmation candle. You must wait for the confirmation candle. And the confirmation, and I said the confirmation must be a full red candle. Now you may tell me, but this is a red candle. This one that is next. But it's not a full, if it's a full red, it will come down as a full red.
So we're not seeing your screen.
You're not seeing my screen? Oh, okay, sorry. I didn't.
Yes.
Oh, apologies. Can you see my screen now? Can you see it now?
Yes, you can see it.
Okay. Now, from what this person is saying, I think Cheesy also. Let me confirm the name again. Yes, Cheesy Nation. It's saying that there's a shooting star on gold. This is the shooting star I can see at the moment, but then it's not valid. Why is it not valid? Because there's no valid confirmation candle. The next candle to it must be a red candle, and it must be a full red candle, not another candle with a long shadow and small body like this one. So it's not a valid shooting star. I mentioned that in the course of the training. That's the one you're talking about, yes, but it's not valid because the next candle must be a bearish candle and it must be a full candle with full body. What makes it more valid? That's what I said. It must be a full candle, red, because you're looking at reversal to downtrend. It must be a red. This must be a red candle. Now you may say that, but the next one is red, but it has shadows. The one I'm talking about must be full. It may have tiny shadow, tiny, very tiny, but not full, long shadow and tiny body like this one. So it's not valid. And that's why you can see that price did not fall. It still kept going up. So that's the first confirmation. The second confirmation is that you must also look if there is a resistance. I said it that candlestick patterns work better when you find them around resistance and support. Is there any resistance at this price level? Let's check 1 hour time frame. It's not valid. The valid resistance level here is actually this range here, and price didn't get there. Price did not get there. This can still be a range. Price didn't get there, so it's not valid. It's not a valid one. So you need to trade candlesticks with caution. They are powerful, but you need to get it right. All right, let me respond to the other questions as we begin to round up. Olushino Oshisonya, kindly drop the recording on the group. Definitely, I'll do that. Eric's S20, my problem is identifying a strong support and resistance. Resistance level is the price above, is a level where price cannot break above. Like in the current candle, current formation you're seeing on the screen, you can see this level I marked with the ash color is the highest level. So if price touch it again, there's a tendency it may reverse. That is because this level may become or has become a resistance level and price did not break out above it. While support, so at resistance, we're looking at the opportunity to sell after price did not break above it. While the support is when price touch the same level a minimum of 2 times. 1, 2. So if price returns to this level, there's a chance that it may reverse to the upside. So that's just simple thing about resistance and support. All right, that'll be the.
Can I, excuse me, sir? Can I ask the
Yes,
question?
please go ahead.
Okay, thank you so much for the class.
You're welcome.
You talked about doji, and in my own understanding and the knowledge I have about doji is actually what do you call it? Indecision candle. When you see it, you just
Yes,
take a pause. But when you talked about doji now, you said it's like a reversal kind of candle when you see it in certain way. So I'm kind of confused.
I said it's an indecision
Can you
candle.
explain more?
Yes, I said it's an indecision candle. I mentioned that. I said if you find it at the top of an uptrend, at the top of an uptrend, for example, this move here can be taken as an uptrend if at the top of this uptrend movement, we ended up with a doji. This is a doji here. It can lead, this is a perfect example. At a resistance, we find a doji, it will lead to a reversal. This is a doji in the middle of a trend. Now, if you watch
Okay.
what I'm saying, my emphasis of our candlesticks is finding them around support and resistance. They are more valid. If you find them in the middle of a trend, it's a 50-50. It may work or not work. But when you find them around resistance and support, it gives them more validity. Are you getting it now?
Okay, sir. Yes, sir.
All right.
No, thank you very much.
You're welcome. Okay, somebody is raising his hand. I think that's the last question I'll take, and we should be out of it. Please go ahead. The person raising his hand. Samsung SMT225.
Yeah, good afternoon, sir.
Good afternoon.
All right, so please, you made mention about the doji, and you state the first condition that the second candle must be a full candle. Then you talked about the second condition. I didn't get that place well. Can you just help me, please?
Okay,
I didn't get it.
I was responding to, so it's that was not the doji, that was the shooting star that this
Yes,
other
the
person
shooting
asked.
star.
Now,
Yes.
in this example here, which is a recent movement in the market, this is actually it's a shooting star. But the issue is the confirmation. Now, there are two confirmations you need. The first one is the next candle to the shooting star must be a bearish, a full bearish candle, not one that looks like it. Not even this one is a doji, not one that looks like a doji. No, it must be like a full candle. Generally, it's called a marubozu. It must be like a marubozu candlestick that is full body. It may have tiny shadow, no problem, but tiny, but not a full long shadow. No, that invalidates it. So in this example now, if this was a big full candle red, then I tell you that price will go downwards. But then there's also another confirmation, and that is the resistance and support angle. For a shooting star is expected to generate a bearish signal. So it's better when it is found around a resistance. If you find it around the resistance, it will give it, another level of validity. But in this case, the confirmation candle is not valid. It's not also found around the resistance. So, and that's why you can see that instead of selling straight, it still continued trying to buy. And I believe it's trying to target that resistance zone. On getting to the resistance zone above, well, we may see a reversal, but it may have nothing to do with the candlestick pattern. So this candlestick pattern here is invalid.
All right, then if you look at the left hand on the gold, 15 minutes, that left hand side, it works. It actually works. The shooting star there works. Yes.
Yes.
If you place your line on the right hand, you discover that the range at the resistance and take out that low. It takes out the low. So it actually work before the bull hand begin.
Well,
it actually work.
Which low are you talking about?
Before the bull movement now
are you talking about this one?
It works. No. The left hand.
Sorry.
Left hand.
This? I'm not getting you. Well, our reference is here.
Yes. What I'm saying is where you just circle at the middle. Yeah, the shooting star at the left hand here. It comes down and now it works. What I'm saying here is the market play out. This shooting star here.
Are you talking about this one?
Where you are pointing? Yes. It plays out.
Okay.
It plays out. So it works. It takes out this low, and the bullish now begins the actual movement. So it takes out this. Yes, it takes out this low before the bullish now begins the actual movement.
Do you mean this low?
No.
Which one?
No.
This is a low.
Yes, the one. The actual movement on gold was bullish. What I'm saying here is this shooting star here works. It comes back at that resistance and therefore take out the down low.
Okay, this is what you are saying. This resistance. It drops to take out this low.
Yes, it drops before the bullish movement. So it actually works here, but it just depends on if you are trading. You need to be careful knowing your trend.
All right. Thanks for that contribution. Okay.
Thank you, sir.
Somebody else is raising his hand. Think global. This is the last I'll take in question as we round up. Think global. Go ahead, please.
Okay, thank you very much, sir. I'm sorry I came in a bit late, but I just needed a little clarification on this same candle we are talking of, because we are using 15 minutes time frame. is it applicable on any time frame, or it has to be only 15 minutes time frame?
Okay, it's applicable on most time frame. I would say avoid lower time frames like 1 minute, 5 minutes. Now you can use it on 15, 30, 1 hour, preferably for entries. Now somebody was asking if you could use it on daily time frame. I said yes, only if you are using it for direction while you look at the lower time frame for entry. Now that's covered under what is called multiple time frame analysis, where we look at direction on the higher time frame and we look at entry on the lower time frame. So if you're looking at the daily time frame, for instance, it can give you will find a doji on the daily time frame, for instance. You are not expected to enter a sell on the except you are a swing or position trader, because the stop loss will be very large. That's the reason. But if that is your entry normally, maybe you have a big account and you trade, you make entries on daily time frame, you look at your trade running for weeks, that may be okay. But if you're a day trader, you look at the higher time frame like daily for direction, and you look at a smaller time frame like 1 hour or 15 minutes to make your entry. So if on the daily time frame, for instance, you find a resistance, and sorry, on the daily time frame you find resistance, and on the 15 minutes chart or 1 hour, you find a shooting star, perfect. Because that's a lower time frame you can enter with. But if you find a shooting star on the daily, you can't make that entry on daily, except you come down to a lower time frame so that you can practice your risk management in a better way. How to answer the question? I think it's off. Maybe network issues.
Thank you, sir. When are we going to have this kind of class again now? This is very resourceful.
Yeah, don't worry. On Wednesday, we'll still continue. More practical, more hands-on. Don't miss it. Wednesday, that's 2 days from now, by 4 p.m. We're still going to have exactly this class, but in a more expanded format and more practicalized session. So don't miss it. All right. So, and if you live around Abuja and its environment, we're having a physical training tomorrow, 11 a.m. If you're in Abuja, in this environment, the address is 50 Ebitu Ukiwe Street, Jabi, Abuja. And if you live in Lagos and its environment also, you can come over to our office at 54B at Denny Jones Avenue, Ikeja, Lagos. Time is 11 a.m. Tuesdays and Thursdays. All right, that'll be the end of this session.
On Adeni Jones.
I didn't get you, sir.
Are you close to Rally Trade on Adeni Jones in Lagos?
It's the same road, but a little distance apart, but not too far anyway.
Okay. I think I will visit your office in Lagos.
We'll be expecting you. Okay, Cheesy Nation, you live in Abuja, then you can visit our office. The address in Abuja is 50 Ebitu Ukiwe Street, Jabi, Abuja. That's for Cheesy Nation. Physical training runs there tomorrow. You can attend. All right, it's been a wonderful time this session. Take care. Enjoy the rest of the day. Bye-bye.